Funds. Welcome to our webinar on successful value investing in small to mid-cap stocks. Today's presentation is from Forager's Chief Investment Officer, Steve Johnson. Please note that this webinar is general information only. If you're intending to invest at any point, please seek professional advice. The presentation today will run for 30 to 40 minutes, and then there will be an opportunity to ask Steve some questions. You can type your questions in during the presentation, and time permitting, we will go through these at the end. And now over to Steve.
Thank you, Alex, and welcome everyone. You'll have to go easy on us today. We're trying this technology for the first time, and something that we're hoping to use a bit more frequently in future around the quarterly reports and our upcoming roadshow as well. Just a quick summary of our business for those that are new to Forager. We run two investment funds. One of them on the right-hand side there is the Forager Australian Shares Fund. That was our original flagship product. It's been going since the end of October 2009 and is now listed on the ASX under the ASX code FOR. And on the left-hand side, our newer International Shares Fund, although it's also been going for more than 4 years now. About $150 million invested in there and is still open to new investments. Just what we're going to run through today, it's a bit of a back to basics for those that haven't been with or followed Forager for a long period of time. And I'm going to talk about the particular part of the market that we operate in. So how to think about value investing in the small and mid-cap end of the market as opposed to larger stocks, and as opposed to what I would say is typically done at the small end of the market, which is growth investing. We'll talk about some of the pitfalls to avoid when investing, both ourselves and a lot of other small cap investors out there. Talk about a topic very close to my own heart, which is the right sort of mindset for value investing, and I think it's even more applicable amongst smaller stocks. We'll talk about a few of the current portfolio holdings, the more important ones in both portfolios, and then we should have plenty of time left for questions at the end of today's webinar. You can put those in anytime, Alex, is that correct? I think you can put those questions in as we go along, and we'll try and get through as many as we can at the end of today's presentation. So I'm going to talk about some basic concepts of value investing here, and most of what you see at the small cap end of the spectrum, particularly in Australia, is very focused on growth stocks. So trying to find a business that's going to double, triple, quadruple its profitability over the next few years. What I'm going to talk about today is value investing, and it's obviously a widely practiced method of investing. It's less common though at the smaller end of the market than it is at the bigger end of the market, and particularly when I look at our international fund, it's much more common in the US than it is in other parts of the world. We need to answer three very simple questions, and we can value any stock or really any financial security for that matter. It doesn't have to be a share. If you can answer these three questions, you can value anything. How much cash are you going to get is the first question. What's the quantum of it? When are you going to get it? i.e. how long is it going to take? And how sure are you? And really, if we can answer those three questions, we can value any cash flow stream, and it doesn't matter whether that cash flow stream is growing or whether it is shrinking or whether it's going to stay consistent for a long period of time. As long as we can answer those questions, we can value something. And it's wonderful to own a business that has a growing stream of cash flows, and we will typically pay a lot more for growth than we would for something that's not going to grow. We've also had a lot of success though buying stocks that are going to shrink for substantially less than the value of that shrinking cash flow stream. We're very focused on the underlying businesses here. So you'll see this is a very common mantra out of the value investing world. We're buying businesses, not stock prices, and we're very focused on what we think that business is worth. I think it's really important though, and this is a trap that we'll talk about a little bit later. It's very important to remember what we're trying to do here when we value something. We're valuing the cash flow that comes out of a security, not the cash flow that's inside it. So a lot of people will just value a business and then say, okay, the business is worth that, therefore the shares are worth this. It actually is very important to think about how that value is going to be returned to you as an investor. Now, we can and do own businesses that don't pay dividends for very long periods of time, but the trade-off there is that you are buying a cash flow stream where the management of that company is going to be investing those profits on your behalf for a very long period of time to come. Very important in that scenario to be thinking about what those reinvestment rates are going to be. I touched on earlier we run 2 funds, and I like to think that we are very flexible in terms of the type of opportunities that we find. And I've put up on the slide here, we are willing to invest in and attracted to opportunities where the narrative is unappealing. We like to look in unloved, under-researched places, and we like to have some special insight or understanding about a business that the rest of the market doesn't have. Understanding what our edge is really important, and often that edge is as simple as, well, people hate this part of the market and they don't want to invest there. Globally though, we've had a lot of success buying much higher quality businesses, and I don't want anyone that invests in our Australian fund either to think it's always or exclusively going to be beaten up, bombed out companies. We're constantly trying to value the cash flow stream, and if we can find a really good quality growth company at an attractive price, then we're quite happy to own those as well. My experience has been here in Australia that space is very, very competitive. There are a lot of funds whose mantra is to buy high quality businesses with great management teams and not pay a whole lot of attention to price. Because of that, we've mostly found those stocks to be expensive and haven't invested in them, and have had a lot more success in Australia at the more beaten up end of the spectrum, but internationally, and I think it just shows that flexibility, we've been able to find stocks, usually because there's pessimism around the macro environment or the country in which a stock operates in, where we've been able to buy better quality businesses at very attractive prices. We'll talk about a few of those later in the presentation. Risk management is very, very, very important. It's important whether you're buying high quality growth companies or whether you're buying lower quality companies. Something that we have to deal with though, that if you buy a company that's got a lot of cash on the balance sheet and is a good quality company, the chances of it going broke are very, very small. Some of the businesses we invest in, that risk is heightened, and we need to analyse it, we need to manage it, and we need to take it into account in terms of our portfolio construction. We have and will continue to put small percentages of the portfolio into stocks where we may, and we talked about this quite openly with Whitehaven Coal in January last year. We bought a stock where we thought there was a meaningful probability of that business not surviving, but where we thought the upside was potentially 10 times our money. Now, that means for us that we can invest in some of those opportunities. We just need to be really careful about portfolio allocation. And in that situation, that was a 1% weighting in our portfolio, where a typical opportunity is often 5 or 6%. We talk a lot about risk management. It's a different approach at Forager than a lot of other asset management firms that are very focused on share price volatility. Our approach to risk is the same as our approach to valuation. We're trying to value businesses and we're trying to understand the risk behind those businesses as well. And we're trying to put a portfolio together where we are not concerned about share price correlation or volatility, but we are very concerned about business correlation. So we run a regular analysis of our portfolio and think about what type of risks we are exposed to and how much in our different portfolio positions share. So that's a basic summary of how we go about valuing stocks, and if you're anything like me, you probably come to value investing and it makes a whole lot of intuitive sense. The practical realities of it are much more difficult to apply than the theory. And I want to run through some of the pitfalls that I see out there. Firstly, some pitfalls that I see out there in general in small cap investing. And the next slide, I'm going to talk about some risks or pitfalls that are specific, I think, to value investors like us. This one's the wider small cap end of the market. And the biggest one that I see is that most or a lot of small cap investors can be suckers for what I call the narrative fallacy. We all like a good story. Our human brains are wired to appeal to a good story, and the problem is that it can become detached from valuation. And we saw a lot of this 12 months ago in the Australian market. A lot of businesses, there's absolutely nothing wrong with the business. They've got a lot of good growth prospects ahead of them, but people justifying absolutely any price because the story sounds good. So you need to understand the story, but that story needs to be put into the context of an appropriate valuation for the stock. I see a lot of overly optimistic growth projections. I think this is particularly relevant here in Australia, where we have a relatively small economy. You need to be very conscious of the practical limits on how big a business can get. You see a lot of companies in Australian retail land get to $200, $300 million worth of retail sales and then hit a ceiling in terms of how far they can grow. It's really important just to look at the business that you're looking at, think about the market that it operates in, and what are the practical limitations to how much it can grow. Whether you're investing in a small cap stock or a large cap stock, you need to think a lot about competitive advantage. And I see a lot of people out there see a company that is growing, that is performing very well, and they just extrapolate that growth into the future without thinking about the competitive response. Any business that is earning fantastic returns is going to attract envy and is going to attract competitive capital, people that want to steal those profits away from you. You can be in a very fast growing industry and you can have a period of very profitable growth for your company, and then as the competitive response comes in, those returns can shrink quite dramatically, even in an industry that continues to grow. We've seen a lot of this in a sector like aged care in Australia over the past 20 years, where I think going into what I would call the second boom there of, an aging population and the demographics look wonderful. The problem is there's no competitive moat that stops more and more capital coming into the sector. Probably more of a problem for me than for you, but liquidity is a big issue at the small end of the market. It costs us money to get into illiquid stocks, and it costs us money to get out, and it can cost us a lot of money to get out if we're wrong about an idea. That means, firstly, we need to have a long time investment horizon, so we effectively amortize that cost of liquidity over a long period of time. We also need to take what I call almost a private equity style approach, that we're, like I said earlier, very cognizant on the way the value is going to come out of the business without us being dependent on the market to realise our returns. And long-term investors in the Australian fund will have noticed many takeovers, capital returns, special dividends, things like that as ways of us realising value. I think it's just something to be really cognizant of at the small end of the market, and that you should demand higher returns for the lack of liquidity that you take on in these stocks. Globally, I see a very frequent failure to appreciate cultural differences in international markets. One of the big, and this is part narrative fallacy as well, but we often take our own home market experience and extrapolate it into foreign markets. Talk about a mistake of our own, but we own a German DIY company called Hornbach Baumarkt. It's actually owned by a number of Australian fund managers, and I think we've all made the mistake of looking at Bunnings and saying, wow, what a wonderful business that is in Australia. DIY is going to be a wonderful business in Germany as well. It's a very fragmented market, it's hyper competitive, and there's not a lot of rational pricing there. And there are a lot of family-owned businesses who have no intention of merging their business with someone else. So it's an example of people extrapolating their home market experience into global markets, and I think that can be very risky. And finally, I think it's easy to get too close to management at the small cap end of the spectrum. Management is more important of small companies than it is of large companies. It is very difficult, unfortunately, to work out who the great ones are in advance and buy at a price that is not already factoring in that management team's quality. And I think one of the mistakes that you can make is to get too close to them and let the story that they tell you and the relationship with them cloud your judgment. Now, some of the mistakes that we can make as small cap value investors as opposed to in general at the small cap end of the market, I think this is a very important slide, both for people potentially investing in our fund and wanting to do it for themselves. I think, and I've historically been guilty of this myself, I think there's an over-reliance amongst the value investing community on NTA. We love to buy stocks at discounts to NTA and we want to sell them at a premium to NTA. And it has been a very useful metric for us to think about a business, but it is only that, a useful metric. And I've seen plenty of businesses bought for half NTA that are trading at 100% of NTA a year later, not because the price has gone up, but because the NTA has come down. And I think that's particularly the case with long-lived assets. You know, if you've got, we've seen this with PMP and the whole printing space over the past 10 years. It's a sector that is shrinking, and when you've got a lot of sunk capital in a sector that is shrinking, that asset backing is not very useful to you. Whereas if you are in a sector, and we've seen this in mining services over the past few years, where those assets need to be replenished more regularly, then I think the NTA is a more useful metric. It's just dangerous to assume that it in itself is a measure of value. Same with low earnings multiples. I think the gap for most value investors between what they're prepared to pay for a quality business and what they think is attractive for a poorer quality business is not wide enough. 8 times earnings can be really expensive for a business that shrinks, and 20 times earnings can be really cheap for a business that grows. And for me, it's important to recognise which type of business that you are buying and be prepared to value them based on that growth or shrinkage. And put a quote up here from Charlie Munger: it's hard enough to pay a low enough price for a business that's in decline. And this is a really simple exercise to go and punch some numbers into a spreadsheet yourself and value a declining cash flow stream. It makes a dramatic difference to your returns if a business is shrinking at 3% per annum rather than one that's growing at 3% per annum. I've already touched on this a little bit, so I won't labour the point here. I think we tend to make the mistake of focusing on what the actual company is worth rather than thinking about some of the incentives to get that out. We'll talk about McMahon later in this presentation. It's a perfect example of a business where you can add up the asset backing and the cash and get very excited about the opportunity there, but there's no chance of that cash coming back to us anytime soon, so we need to value it on the basis of it being an operating business. I think people tend to underestimate the costs of realising value. We often do this sum of the parts analysis, and there's different parts of the business here and there. You very, very rarely get that money out at full value. You need to take haircuts, and I think when you're valuing some of these businesses, it's important to apply significant haircuts to different parts of the business. On the international side of things, obviously FX is a big one. You buy a business in the wrong place and you do a great job of it and get a wonderful business, and you can see those returns eroded by depreciation of the currency. And I think cultural differences with regards to value realisation, I guess this is just backing up the point above. You can run a filter in Hong Kong and you'll come up with 20 companies that are trading at less than 20% of their NTA and have net cash on the balance sheet. If that was the case here in Australia, even more so in the US, we'd be all over ourselves with excitement about the opportunities that are there. Our experience in Hong Kong has been that money never, ever, ever comes out in the vast majority of situations, and it often disappears off to related parties and the NTA evaporates. So it's just important to recognise in different markets there is more emphasis on value realisation. Just got the one slide here, but I think it's really important to think about whether you're the right type of person to practice this sort of investing. The point at the bottom of the slide is probably the most important. A low-cost index fund or sensibly constructed portfolio of blue chip stocks is going to generate you perfectly adequate returns over the long term. If you're going to do things differently, and particularly if you're going to invest in a contrarian value type way, you need to be a different type of person. I put a few questions up here to ask yourself. Do you feel anxious when share prices fall? I think good value investors tend to get excited rather than anxious. Can you think rationally when those things are happening, when prices are falling and the emotions are starting to take hold? Do you struggle to think of a realistic downside when buying a stock? I think this is a really important one. That level of realism about any stock is important. That you should be able to think of a downside for almost any stock that you buy. You should understand it, be thinking about it, and applying a probability to it. And you need some basic financial skills. You don't need to be the greatest mathematician in the world, and sometimes I see people can be too smart when it comes to this style of investing, but you do need to be able to understand business and be able to decipher financial statements. Just want to talk about both of the portfolios here and a few of the stocks that we hold. Just a general comment on the Aussie market at the moment. You'll see these names on the slide, with the exception of NZM, they're the same names that would have been up there this time last year. And some of the share prices have run very hard, and as you saw earlier on, the portfolio performance has been very good. The market itself has actually been very difficult, particularly at the small cap end of the market. I saw a slide from UBS the other day that had price movement since August 2016 at the small end of the market. And there were more than 30 stocks that had fallen more than 40% amongst a cohort of what I would call larger small caps. This is not no-name stocks, but some of the ones that you would have seen out there, like Bellamy's and Vita Group. There have been a lot of blow-ups at the small cap end of the market, and we've been either fortunate or skillful enough to avoid most of those in the portfolio. So it's been a really good year relative to the market, but an even better one relative to a lot of the competition out there. We're not necessarily replacing the ideas that we're realizing as quickly as we would like. And in part, that those stocks that are down more than 40% is quite exciting, because there is a lot of nervousness out there at the small cap end of the market. Companies are being punished very heavily for relatively small disappointments, and there's actually quite a bit of money coming out of the small cap end of the market. Funds that are having withdrawal problems and having to redeem investments that are selling stocks. So we've seen some pretty dramatic movements. We haven't got excited about a lot of them yet. There's a few that are not on this slide that are new additions to the portfolio. I've seen a few more over the past few weeks that I think are potentially interesting, but these stocks, despite falling 40% and more in some cases, still aren't enough to get us excited at the moment. I'll run through a couple of these opportunities though. Macmahon on the right-hand side here, it's probably still my favourite idea in the portfolio. You won't often see me say that about a stock that's doubled over the past year and tripled over the past couple. But they're in the midst of a fairly meaningful transformation here. The stock still trades at around NTA, and that's a very heavily written down NTA. Through the mining bust, they wrote down the value of a lot of their assets. I think as that equipment market starts to tighten up out there, those asset values are probably conservative. More importantly, though, they're winning work, and that is a result of a new CEO that started working for Macmahon in September, October last year, Mick Finnegan. He's very well connected in the industry and is winning some large and important contracts for that business. This was a company that was doing more than $1 billion of revenue a few years ago. This year it's going to do 300 and something million. It still has the infrastructure and the overheads to be a bigger business. So it either needs to shrink those dramatically or it needs to get bigger. And it looks like the latter of those scenarios is looking more likely that it is going to get bigger. It's not without risk. CIMIC is on the register with a 23% holding at the moment. They launched a takeover offer in January. We weren't impressed with the price, but they're still, I think, being difficult in terms of this business's future and its value realisation. And McMahon has recently done a deal with an Indonesian company in exchange for a very large mining contract. They're contemplating issuing that company with 40% of the scrip. Now that would dilute CIMIC and take that problem away, but it may replace it with a different one. We still think that looking out a couple of years here, this business is going to be making cash flow and profits that is very substantial relative to the current market cap. And then there's two holdings on the left-hand side there. Service Stream has been a wonderful investment for us over the past 4 years. It's just come out with another profit upgrade, which is, I think, the 8th half-yearly upgrade in a row. The business is going wonderfully well, but the share price is up 7-fold now since our recapitalisation of the business at about 20 cents a share. It's in a very good place. It's going to keep growing for a few years yet, but we are starting to question what the end of the NBN rollout means for this business and how it's going to sustain what is quite a high level of profitability once the NBN is finished. We're really impressed with the management team. We've been reluctant to sell it, but the share price is starting to look quite full. And then Reckon, they're next door, which is one that I would not be surprised at all to see it taken over the next 12 months. They own a very good corporate accounting business, so providing core accounting software for large accounting firms. They operate with 4 of the largest 5 accounting firms in Australia. We think that part of the business is worth the current market cap alone. Then they've got a large database of SME customers that are using an old product. They're losing those customers to Xero and increasingly MYOB, but we still think it's a pretty valuable database in the interim. Reckon has announced plans to spin off part of its business and list it. It's called the document management part of the business. They're talking about listing that on the AIM in the UK. We think it's a crazy idea, and as one of the largest shareholders in the company, we're not very impressed with that, but it is a business with a lot of strategic value. In the international portfolio, this portfolio has seen quite a bit of change over the past 12 months. That's because some of the stocks that we were very excited about last year have performed very well. 2 of our largest ones, LN and Lotto 24, are up. Well, Lotto 24 has doubled over the past 12 months and LN's tripled. And that has caused us to sell some of those shares. There's a relatively new holding at the top of the list now called Just Group. We bought this UK annuities provider in September last year. It was beaten up by Brexit, and then it's been beaten up a bit further by some regulatory changes in the UK. This company sells medically underwritten annuities. So you say, give them £100,000 and they will guarantee you that they give you £4,000 or £5,000 a year for the rest of your life, and they take the risk of you living for longer than they think, but they're mostly selling those policies to customers where they've done a medical assessment of how likely they are to live a long period of time. So if you smoke and drink, you may have disadvantages elsewhere in life, but here you're going to get a better price from them. We think it's a really good business. We think it's got some unique competitive advantages. It's trading at a discount to book value, and we think it can grow for a meaningful period of time. Lotto 24, it's one where the share price is up a long way. We haven't changed our valuation of this business one iota. We thought it was worth somewhere between 10 and 13 to 14 euros when we first bought it. It was trading at 3 and it's now trading closer to 10. So it's getting to the bottom end of the range of what we think is fair value, and we've been taking some money off the table there. A couple of names that are probably more familiar to people, Lloyds Bank and Alphabet up the top of the list. And then a new holding, I don't want to say too much about it today because we haven't written much in the quarterly report, but an Italian cement company called Cementir. Most of their business is actually in Scandinavia, and then they have a business in Italy, one in Egypt and Turkey as well. We think that cyclical part of the European market still looks quite attractive. As you can see in our portfolio, the high quality growth companies have already run very hard. I'm seeing a lot of articles out there talking about the attractiveness of Europe. it's a bit late to be piling into some of those companies now because the share prices are up so much. We are still, though, finding quite attractive opportunities at the more cyclical end of the market. There's just a company there. I talked about Lotto24 and Just, but LN as a really good example, so the one in the middle, it's a really good example of the type of investing we've been able to do internationally that we haven't been able to do here in Australia. This is a really high quality business. They sell aesthetic and medical laser equipment, so non-invasive laser equipment that is used for cosmetic surgery, tattoo removal, blemish removal, and some medical operation stuff as well. This business has been growing for 15 years fairly consistently. They've got a good track record of capital allocation. They had spun off one of their businesses in the US. At the time we bought it, that company that they'd spun off was trading for more than the entire value of LN. There was just nothing that a rational person would have looked at and disliked about this business. It was net cash on the balance sheet, paying dividends, growing for a long period of time. The only reason it was cheap was because it was in Italy, and uninvestable is one of the favourite words that I hear out there because it makes me go and look, and that's what people were saying about Italy back in January last year, that you just couldn't invest there. Now, obviously, you invest in an Italian company, you have risks, but this is a business that almost all of its revenues are in Asia and the US and wider Europe. It would benefit if Italy left the euro area and had a cheaper currency because most of its costs are local ones. So we actually weren't concerned about sovereign risk here when it came to this particular business, and yet we were able to buy it at 10 times earnings. Like I said, the profit's up, the profit's up 10 or 15% again over the past year, which is consistent with its history, but the share price is up threefold. So we've been taking money off the table fairly aggressively with that one as well. We would love to own this business for a long period of time, and hopefully we'll get a chance to come back into it in a larger way. It's still an important position in the portfolio, but it was a large position at this time last year, and we'd like to see it there again at the right prices. Okay, I think I've talked for long enough. We want to apply plenty of time to some questions. Alex is going to look through what you've been asking and I'll answer them. So you can still keep punching questions into the questions box. Is there nothing there, Alex? Is that what that says?
Looks like there's nothing there at the minute.
Okay, so we'll just give you a couple of minutes to lodge questions into the question box, and then we'll answer them for you.
Hi everyone, we did have some questions, so I will start by reading them out. So the first one is from Daniel. Hi Steve, Are your investment theses in Matrix Composites and Engineering and Boom Logistics still intact? And would you consider them still cheap today? Have you or the team considered researching Caprol Limited or Hills Limited?
Thanks, Alex. We haven't had a good look at the last two of those questions, so I won't comment on those. But two portfolio holdings that are in the Australian fund are Boom and Matrix. Matrix first, because it's quite a different situation. It's got a very strong balance sheet, this business. It's meaningful net cash. We don't expect any turnaround in the business for quite some time. Matrix sells buoyancy risers in the offshore oil and gas market. It's very late cycle work that they do. So even if the oil and gas market recovered tomorrow, which there are no signs of it doing, you're going to be a few years before that means meaningful orders for Matrix. But we think that there's some interesting things happening in that marketplace. One of its competitors has gone broke. Matrix is in a very strong position with its balance sheet, and we just wanted to ride out what is a very difficult market and think that in 5 years' time, the business can be substantially more valuable than it looks like today. Would I buy it today? The share price is up probably 30% from where we were last buying it. We still think it's maybe mildly cheap, but not screamingly so. Boom Logistics is, I would say, an investment that hasn't worked out for us, but hasn't cost us money. They are also repairing their balance sheet, but we really wanted this business to come back to a meaningful degree of profitability and be returning cash to shareholders by now. We're not very impressed with the job that management or the board have done there. And it's just been disappointment after disappointment in terms of the results that they've announced. So the share price where it is doesn't factor in an improvement or any sort of dramatic good news there, but we're not expecting any either. So it's not one, when I look at the portfolio, that I'm expecting substantial gains out of over the next few years.
Okay, great. Thanks for that, Steve. So our next question is from Brad, and this question is, how do you engage with management in your overseas investments? Do you visit personally or phone? Do you have plans to increase your staff levels as well, or do you feel you are about right?
Great question, Brad. Thanks. We meet with almost every management team of companies that we own globally. Most of the stocks that we're investing in are in regions that are pretty close to where one of our analysts lives. So we've got Kevin in North America, Gareth in Europe, and I'm on trips to both of those places fairly regularly. So we tend to tie up a management visit with my tours around the world. Like I said earlier, I'm skeptical about how much value gets added from meeting with management team, and I do think you can get too close to some of these teams, but it's a really important part, I think, of filling in the holes once you've done your research. It's very dangerous to do the management visit first because you've got a blank slate and management are going to fill that blank slate with their own version of the world. But if you've done your work and you go in with specific questions where you need some help filling in the holes, I think it can be very useful. We probably actually do more of it in the international fund than we do in the Australian fund, and that's because we've owned better quality businesses there that are retaining more of the earnings, and where it's really, really important that we get confident that the management is going to do the right thing. And there also tend to be more family-owned businesses there, so getting to understand the family's motives and what they intend on doing with the business is also very important. There was a question on analysts there as well, wasn't there?
Yes.
We need more people, no doubt about that. We are actually in the middle of recruitment. We are recruiting a replacement for Daniel on the Australian fund side of things, and also potentially looking at a relatively senior resource on the international side. Our grand plan here is to grow our funds management business to something like the 800 million to $1 billion level. We think we will be capacity constrained internationally as well. As a business, that means we need to do it with a relatively small team, and these next few hires for us are therefore going to be very important in terms of getting the right bums in those seats. We don't want a massive team of people, and I don't think you necessarily get better investment decisions out of a huge team, but we do need to or want to cover more parts of the world, and that requires a larger team than we have at the moment, particularly on the international side of things.
Okay, thanks, Steve. Next question is a stock-specific one from William. Can you explain your thesis behind Alphabet? As a large cap stock, I assume there would be significant equity research coverage that would factor in the undervalued nature of the business.
Thanks, William. That's a good question, and I'd say there's a couple of businesses in the international fund that are in that category. Lloyd's, is widely covered and widely owned as well, and it's a large cap stock. We've made a couple of exceptions, and it's important to think about the portfolio composition of that international fund. We started out in 2013 relatively inexperienced, and one of our main aims over the first few years was not to make big mistakes and not to make too much of a mess of things. As we've got increasing confidence, and as we've just been looking and working for a longer period of time, we've slowly replaced larger, more liquid, safer businesses with stocks that are more our bread and butter, i.e. we think that they can substantially outperform the market over a long period of time. The two that are still in there are Lloyd's and Alphabet at the moment, and you shouldn't be surprised if you see other large cap stocks come into the portfolio. The reason is we still like both of those businesses a lot. They're not going to double and triple the way an LN has, but they're both in a very good position in terms of their market dominance. Talk about Alphabet really quickly. It's not like this is not factored into what people are valuing the business at. I just think it is a wonderful business that continues to grow at very high rates, and I still don't think that the marketing world has caught up with the eyeballs. So Kevin in New York's got a friend that works at Unilever. They recognise that people's behaviours have shifted and that they're spending more time online and less time watching television. They still don't know how to spend their budgets effectively online versus the way they've done it historically. And that's because they've got 40 years of experience making TV ads and doing marketing the way it was done 10 years ago. They're slowly coming to grips with how that should work online. So I don't expect this business to provide us with crazy returns, but it is a really nice place to have some cash parked at the moment. And I think it's going to deliver high single-digit returns to investors for a long period of time to come. And I put Lloyd's, maybe the expected return from Lloyd's is slightly higher, but the business is in a really good place. They've fixed the balance sheet. It's got a good management team. It's back paying dividends again. It trades at about book value for a company that is earning a 15% return on equity. So it's a business that we like and we think is going to deliver us perfectly adequate returns. And we just want this portfolio to have some balance. If you go into a big market meltdown or another financial crisis and you own a whole portfolio that's full of very small cap illiquid stocks, you're going to see those prices move dramatically, and we just don't want to be forced sellers of some of those small companies because we're trying to buy something else. We want enough cash on hand and the potential ability to access some of these large liquid companies to take advantage of those opportunities.
Great, thank you, Steve. And now back to a more general question. This one's from Randall. Can you discuss what goes through your mind when deciding to sell a stock?
Thanks, Randall. We try and go through the same process that we go through when we buy one. I think it is difficult. Everyone knows that it's difficult, but instead of making a decision about are we actually going to sell, we're trying to make decisions about whether we've got the right portfolio weighting. And often that decision is easier to make than whether you think you should buy it or sell it. So the easiest example is a stock that was trading at a 40% discount to what you think it was worth, and the share price has jumped up and it's now trading at a 20% discount to what you think it is worth. That is still a stock that is cheap. You may still want it in your portfolio, and therefore some people would say, well, you don't sell it. For us, we would say we probably want a lower portfolio weighting to that stock than we wanted when it was screamingly cheap. And that's the way we're constantly trying to think about things, is do we have the right weighting in the stock, is a much more, I think, rational way of thinking about the opportunity, and it also just makes you line all of those opportunities up against other things in the portfolio. Now, having said all of that, we have lots of internal debates about whether we should be selling things or not, and I am a firm believer that most value investors get anchored to the price at which they bought and they sell too early. And one thing I'm really proud of in our Aussie portfolio is the way we've managed that service stream position over the past 2 years. It would have been really easy to sell that stock after it tripled from 20 cents to 60 cents, and if we'd done that, we would have cost people a lot of money. And it was important to sit there and say, yes, the share price has tripled, but the business is going really well. They're going down a path that we had, and we sat there on day one and said the bull case is this, our base case is somewhere in the middle, and the bear case is on the downside. It was really clear that the business was going the way of the bull case rather than the base case. And it's important that you're constantly updating your valuations as well as the share price. So that's how we try and manage it. And then we also try and think about the tax consequences for our investors of particularly selling things that we've held for less than 12 months.
Okay, great. Thanks again, Steve. Interesting one from Mark. Can you give us an example where you thought you got too close to management?
That's a good question. I would say I can't think of one of those where we've been particularly guilty of it. Some of our biggest mistakes, I think we underestimated the damage that management could do, and Hughes Drilling is probably the best example of that. If I could show you though all of our notes from management meetings and even the initial research that we did, we were very cognizant of the potential for the problem there. We may have underestimated the magnitude of it, but we're certainly cognizant of the potential, and we were certainly arguing with the management team a lot about what they did. Perhaps a Nero, or the old Photon Group when it was Photon Group. We know Matt Maluish quite well there, and I still think he's doing a wonderful job of turning around a very, very difficult business. But it is a difficult business. I think we've done the right thing hanging onto that stock for a long period of time, and I think it's a candidate for some good returns over the next 12 months now that they've fixed a few things up. But it is a business that hasn't generated returns anywhere near what the average portfolio return has been, and maybe I'll put that one down as an example of a management team that we are biased towards.
Okay, next question from Philip, back to a stocks specific question. Can you please speak a little, Ari, the McMahon Indonesian transaction and what you think and what you like about it?
Thanks, Philip. I don't want to say too much here. There's a vote coming up, and I do want to read all of the paperwork that comes out with that before I say too much. I'll probably put some things up on the blog because it's going to be a very important vote. But a few points of context. We are in a situation there where CIMIC own 23% of it already. They have made their intentions very clear, and my view is that those intentions are not around maximising the value of McMahon for all shareholders. They're a competitor to McMahon. My view is that they would prefer McMahon just didn't exist, and I'm very concerned about that in terms of us realising fair value for the business. So the Indonesian transaction needs to be put into that context. In a perfect world, you wouldn't be issuing shares to someone in exchange for this contract. We're going to have another significant shareholder here that is going to exercise significant influence over it. But we're not in a perfect world. We're in a world where we already have a dominant shareholder, and my view at the moment is I would prefer AMNT and the contract that they're bringing to the table to CIMIC on the register. And management have gone out of their way, and the board has gone out of its way to deal with some of the concerns here around this counterparty coming onto the register. And I think the biggest, very clear signal of that is that the shares that are being issued to AMNT are going to sit in trust for the next 30 months in an Australian trust. If the contract is terminated or if McMahon doesn't get paid or something goes wrong with it, McMahon has the right to buy those shares back in exchange for the equipment that it's buying at the moment. Now, the mechanism itself is a bit more complicated than that, but I think the principle is really, really important, that they've put in place a number of mechanisms here to try and deal with some of the concerns that people have. I also, we should be and are always thinking about sovereign risk, but we're not buying a mine here. We're a mining services company that is going to work on a contract. So I think some of the confiscation risks that people seem to be concerned about don't really apply as much to a mining services company as they would if we were buying a mine. And finally, it is going to be transformational in terms of the profitability of McMahon. I'm not talking out of school here. There's a slide in the back of the transaction deck around the AMNT deal that has got some pretty clear numbers around what this contract looks like. Really importantly, the downside is capped at 0 in terms of margin. So even if this contract goes bad, it's not going to be another Telfo where they lose a lot of money on it, but there's the likelihood here is that you're making 8 to 9% margins on this contract, and it's going to double the revenue from McMahon. So we think it's just a superior path to the one that's in front of us at the moment. Again, I'll comment more on that once the actual paperwork comes out.
Okay, this is quite a long question. This one's from Luke. I would be interested to hear what opinion Steve has in regards to the retail sector right now. Many stocks such as RCG, Myer, Green Cross and many other retailers have been sold off significantly over recent months. Are we getting close to a point where one should be scouring this area of the market for potential bargains, especially those that may be less exposed to the entrance of Amazon?
Thanks, Luke. Yes, we're scouring this part of the market very hard. This falls into the category of what I was saying earlier, these formerly darling stocks that have been hammered of late. I think some of it's justified. I think some of it's probably not. And to be honest, I'm flabbergasted about the movement in RCG's share price on the basis of an accounting change that's coming in 2019. I just don't see how anyone changes their value of a business. If you think the value is the cash that comes out, what that has to do with what's capitalised on the balance sheet is beyond me. Look, I don't know the stock well. I took a look at it this morning. I think it's a good example of a space where I'm hopeful that we will find opportunities over the coming months. I'm not talking about RCG specifically, but across all of these beaten up former darling stocks, I think there will be opportunities in there. We've looked at a lot over the past few months and we're not getting too excited about any of them, which is a sign of how far the share prices had run. But look, I'd say over the past few weeks, there's been a few more interesting ones come onto the register. But it's definitely a prospective space, and it gives me a bit of optimism about us being able to replenish the portfolio over the coming year or so.
That one. Okay, question about the Australian fund from Lawrence. Why was Forager Australian Fund listed on the ASX?
Thanks, Lawrence. We are very capacity constrained in terms of what we think we can do effectively in Australia. And we said to clients on day one, we thought the upper limit of what we could manage in Australia was about 200 million. As we approached that level, we firstly decided to close the fund to new money, but secondly had a long, hard think about what the right type of structure is for our style of investing. And we talked to our clients and let our clients vote on this, but came to the conclusion that a closed-ended vehicle is the best vehicle for our style of investing. And that is because if we go through, or when we go through, a significant market downturn, we want to be out there investing all of the money we have available to us and doing that without concern about the liquidity of the vehicle itself. And in a vehicle that is open to redemptions, the manager spends too much of their time thinking about meeting those redemptions rather than about investing the money. So given we were capacity constrained, in any case, we decided we would turn it into a closed-ended vehicle, and the ASX listing is therefore a source of liquidity for investors in the fund who want to sell or buy units. They can do it on the ASX rather than being able to redeem from us or apply to us for new units. At the moment, it is trading at a premium to its NTA, which is obviously good for someone who wants to redeem their investment and not so good for someone who wants to buy. I'm sure that will wax and wane over time.
Okay, and quickly following on from that from Derek, is there an amount of funds under management at which the international fund would be closed?
Great question, Derek. Yes, and I'm going to give a bit of a caveated response to this question. You know, we've said pretty clearly, and I still think this is the case, that something around the billion level is a number that would be great in terms of, or the word is probably a good balance between us being able to find opportunities and the business implications of a fund that size as well. There's a lot of water to flow under the bridge between now and $1 billion though, and there are actually some important, I think, pause points for us as a business and a team to say, are we still going to be effective at this amount of fund? And if I look at the current portfolio that we own, we could scale that to 300 million almost like for like, so we could have exactly the same portfolio that we have today in terms of percentage terms at 300 million. Above that 300 million level, though, we'd have struggles replicating the exact portfolio that we have today. So for us, that means, okay, with the team that we've got, that would be a pause point where we say we need to build depth and expertise in other places and other markets. And we're trying to get ahead of the curve and do that now so that we don't have to stop things at 300 million. But if it happened tomorrow, we would probably temporarily close the fund at a certain level while we made sure we had the team and the expertise to grow it beyond that. You know, maybe there's another pause point there that's 600 or 700 million while we think about all of those things again. But we think long term we can potentially run $1 billion, but we're going to be very conscious of potential constraints along the way.
There's been a few questions about whether this webinar will be available on our website or on our YouTube channel after this. Pending that the technology all works correctly, yes, we'll be uploading it to our YouTube channel and we'll be putting it on our website. So you'll be able to look through the presentation and hear the webinar after the event. That's from Joe.
Okay, yeah, one
question. This is from Joe. Can you talk about the share sale of Gin to Tats?
I think our monthly report will be out in the coming few days and we talk about this in a bit of detail. Look, in the last quarterly we talked about value realisation in parts of the portfolio. Jumbo and Enero were the two stocks that we specifically highlighted, and we've had something happen over the past few months that has helped realise the value in Jumbo. Unfortunately, we don't think it's anywhere near as good as it could be. Lotto Land bought 5% of Jumbo off us, actually. We sold it to them. And I thought that that was going to give Jumbo a lot of leverage, either to get a takeover offer for the company or to get a much better deal out of Tats. I'm not that impressed with the deal that they've done. They've issued scrip to Tats at a discount to market price. They've got some certainty over their contracts over the next 5 years. It hasn't been expanded to Queensland, which I would have liked to have seen. And I don't think Tats was going to pull the pin on them anyway, especially with Lotto Land lurking around as a potential alternate supplier. So, look, the share prices responded positively. I don't think the CEO, Mike Verwerk, has done as good a job with the hand that he was dealt as I would have liked.
I think we've got time for one more very quick question. This one's from Mark. Cash holding at the moment?
Mark, it's roughly the same in both funds at the moment, actually, which makes it easy. I think it's around the 30% level in both funds. We have mandates in both funds to hold as much cash as we want, and we are never going to buy a stock that doesn't meet our return requirements just because we're holding a lot of cash. But you should not expect us to sit on really large chunks of cash for significant periods of time. It's my view that our clients pay us to invest their money in stocks, and that over a 10-year period, we should be mostly invested in something like 8 years out of 10. Both portfolios have performed very strongly over the past 12 months, and we've been disciplined in taking money off the table. But I don't see anything stopping us getting at least some of that money invested over the coming 12 months. Having said that, there's no urgency on us, and you should expect, we were 4% cash in the international fund in January last year. It's as low as we've ever been, and 10 is just normal minimum cash level for us because we want to be able to take advantage of opportunities without having to sell something in the portfolio. So you should think of 10 to 20% cash as dry powder, and anything above that is us cashing in ideas and not replacing them fast enough.
Okay, great. Thanks a lot for that, Steve. And I'm afraid that's all we have time for today, so apologies if your question wasn't answered. Thank you for listening, and I hope you enjoyed the webinar. We will be hosting another webinar at the beginning of August for those who aren't able to make the roadshows that we have planned for that time. So please keep an eye on our website for the announcement of that webinar date. Thanks again, and see you next time.